Welcome to the Spinoff Investing Simplified Spinoff Basics Investing course, brought to you by SpinoffInvestingSimplified.com. All right, well, welcome guys. We're back with Richard Howe from StockSpinoffinvesting.com, as well as myself from SpinoffInvestingSimplified.com. Rich, how you doing? How you doing today?
Hey, doing well, Greg. How are you, man?
Good. So we were talking about just a couple of things that were changed for both of us. Let's share with our audience real quick. You can go first this time.
Yeah, so not a whole lot's changed. So I'm up in New Hampshire with my family, where we're quarantined at home near Boston, but we figured we'd just change the scenery. So we're up here in New Hampshire. There's a lot of hiking and things like that we can do. But yeah, just trying to hunker down here. I mean, luckily, my business involves just looking at stocks, and it can be done working remotely. So that helps. But I don't know what's going on with you.
Well, our viewers should notice that I'm growing a beard. It's my quarantine beard. Here in Twin Falls, we're doing the same thing, trying to hunker down. I'm a member of the Air Guard, and the Guard this year, or for the last couple of weeks, has been doing work from home for us. And I've been able to go out and spend a little bit of time during the day with my kids. And you can see behind me that I have a picture of Washington crossing the Delaware. Somebody, I'm sure, will notice that it's not historically correct, but it's still a great picture. So anyway, awesome. Well, before we get into our normal things on Spinoff Investing Basics, we were going to talk about management today, but we got a great email from Jim. We didn't ask him for his last name, so I'm not gonna share his last name until we get approval from him. But Jim talked with us about one of the things that he uses to value investing, or investing in spinoffs, and it comes from some Joel Greenblatt lectures that he had access to, which you can find on the internet. I did some searching the other day and found a PDF with some of this stuff, but Jim actually gave us the lecture that has the valuation techniques on it. And we're gonna run over that real quick, just to kind of see that it's a little bit different than what both Rich and I shared last time, but it does give another perspective of it. So let me just share the screen here, and we can take a look at it. So let's see. So first and foremost, can you see that, Rich?
Yes.
All right, so here's the lecture, and the lecture talks about a company called Duff and Phelps. And the assignment for the class members was to take Duff and Phelps and then identify what they think the company would be worth at the end of 5 years, 3 to 5 years. And I created a little spreadsheet with that it looks like it hid for me. So give me just a minute, I'll get it up for us. I'm guessing you can probably see this. And go over here. Can you see it now?
It is loading. Hang on one sec. Yep, now it popped up.
Okay, so Duff and Phelps had a couple of things that it shows here, and there we go. So Duff and Phelps was a spinoff that Joel Greenblatt said was a perfect example of probably the best business you'll ever see. And some of the things that he looks at are EBITDA, and then he subtracts out maintenance CapEx. And in order to just make it a little bit easier for me to do this, I went ahead and just took the information off of his case study and put it into a spreadsheet. And I have this, you have the sales there at the top, and then the cost of goods sold. I like to personally look at selling general and admin as well, because I know that that's going to be in there. But from the example that he gave, it didn't have any of that information. Or it was minimal at most. And then you identify the earnings for the company, any interest that they had, taxes and depreciation and amortization. And I actually broke these out specifically because it makes it easier to do EBITDA, as he mentioned in his answer. And then finally, you have your capital expenditures. And one thing of note for anyone that's watching this, pay attention. These capital expenditures are not all your capital expenditures. This is your maintenance capital expenditures, what the company would have to use if they had a perfect example is the coronavirus. They had an experience where they have to just keep the doors open, but they don't necessarily want to grow because they're not sure about what will happen in the next 12 to 18 months. And so your capital expenditures are just maintenance capital expenditures for the company. And sometimes if a company does a lot of acquisitions, that can be a little bit harder to find. But in this particular case, these CapEx numbers are pretty similar, between 1 and 2 million each year. And then you also identify the net working capital of the company, you get the cash, the total current assets, total current liabilities, and net fixed assets. And that gives you kind of the net working capital. You add the net fixed assets to the net of the current assets and liabilities, and then you go ahead and add in cash for that. And that's just the amount of cash that you would need in order to maintain the business. Finally, when we look at the enterprise value, you basically take your cash and your debt and your equity. And I have other equity here just because I wanted to make this a spreadsheet that I could use later on. And there are shares outstanding and then the market capitalization for the company. So the actual enterprise value is your debt minus cash plus your market capitalization. And then when Joel Greenblatt does his valuation, he does a little discounted cash flow analysis. He adds the business growth rates. He assumes debt at the end of the 5 years. He also assumes shares outstanding at the end of 5 years. With Duff and Phelps, this is pretty important because the company has a lot of free cash flow, and then they had nowhere to put it. And historically, the management had not only said that they would put money into buying back shares, but that they would also buy back shares. And then I put in an expected price to earnings multiple just because that's what best fits the answer that he comes up with, which isn't, it's kind of weird. I looked through the numbers and I couldn't get the numbers to work. Maybe we can have a reader or a watcher tell us, hey, this is how you actually get the numbers, because I didn't get the same numbers that he had, trying to do as best as I could tell what he had. And so then I have a summary, and this is what comes up with the price to earnings indicated of 1.5 times your price to earnings ratio, and then a growth rate of 8%. After 5 years, your after-tax earnings is basically EBITDA minus your maintenance CapEx at a 40%, or subtracting out 40% for taxes. And the projected enterprise value is then basically your price to earnings times that number right there. Then you add in the debt to this should actually be your market capitalization, not enterprise value. And then the shares outstanding, and then the projected price of the equity at that time. And he was asking the question, so at $24, do you think this company is a two-bagger, or would it go up 100%? And he was saying, yeah, it goes up to about $50 a share, and you've already earned back all of your investment and then some. Some of the things that he identifies on this is there's a good price test. So the EBITDA minus your maintenance CapEx is 16.2 over that enterprise value that we talked about earlier. And that's an earnings yield of 11.1. He does that very similarly to the way that you and I talked about it last time, Rich. And then he also makes that a T-bill equivalent. So he takes out the tax. So 0.6 times this earnings yield, and that turns into 6.6. And he said, he makes the argument in that lecture, if I can get a company that I know is going to be growing at a 6% T-bill equivalent, then I might as well buy the company as opposed to the T-bill, just because I have expectations that it's going to grow over time. And then the good business test is very similar to what we were looking at, where you take that invested capital and you divide, that's the denominator in your EBITDA over minus maintenance CapEx. And in this particular case, he came up with 365%. I came up with 350, but I think that's kind of a Warren Buffett thing. I'd rather be roughly right than precisely wrong. And I think in this case, 350% versus 365% return on capital, I think that's a pretty negligible difference. But anyway, I personally, just my own experience, I like to look back at the historicals of your return on capital, which is why I put this next section in, and just a return on capital of what the company has done over time. So it does 350% the year that he's looking at it. The year before it was 253%. And then you can also do an operating earnings calculation, which is also something that he identifies, because he uses that to then go back and do his 5 years after tax. And so that comes down here, your future operating earnings, does it make sense? And that's one of the questions that Joel Greenblatt says that any analyst should be asking themselves. You have a growth rate of 19.1% and after-tax earnings of 15.6. And if the company continues to buy down shares, then it's a significant return on the equity for the company. So, Jim, this is to our watcher, Jim. We really appreciate you sending this to us. If you have additional info that you wanted to disclose with us, we would love it, but we really appreciate you sharing this with us. Rich, did you have anything you wanted to add to this, or things that came to mind?
No, I just wanted to walk through it. So just, I guess, starting at the top. So the PE indicated, is that, what exactly is that? Is that the current price to earnings multiple, or is that an earnings number, or what exactly is that?
So that is a guess that you make as the analyst. So you want to look at it and you say, okay, this is how much I think it should be sold at that time.
Oh, got it. So that's your fair value PE that you think makes sense.
Absolutely, yeah.
And that's probably, I mean, that looks like a pretty conservative number, 11.5. If it's indeed growing in such a high quality business, then that's probably conservative. But it's good to be conservative.
Yeah, since you pointed that out, Joel Greenblatt actually puts it at 13%, and let me see if it'll update. And at 13%, it comes up with a projected market value of $203 million from the calculations that I have. Joel Greenblatt put it at $180 million, and so I guess either or, you're in the ballpark with this. It doesn't really change much, but that's a very good point. Yeah. What other questions do you have on this, Rich?
And then the shares outstanding at the end of period, is that how many, is that shares outstanding, or is that shares that are likely to be retired, or what exactly is that?
Those are, so with Joel, the way he looked at it, he said, this is how much the shares will be at the end of the 5 years. And basically what he did is he went down and he took this cash flow right here at the bottom, and he subtracted that into the share count over the 5 years. And he assumed an 8% growth rate in the share price during that time. And basically, I think he started at 7.5 million, and he was expecting it to buy back a significant amount, almost half of their shares within 5 years. So that's a pretty aggressive return, but I looked at it and it's basically like, hey, we're going to take all of our cash and throw it back into this. And he makes that argument as he goes into it, that the reason why they can do that is because this is such a asset light business and a cash light business. They basically can grow without any type of additional property, plant, and equipment. So
makes sense. And then the good price test, so the EBIT minus maintenance CapEx divided by enterprise value. So that gets you an earnings yield a pre-tax earnings yield of 11.1%. And then basically you multiply that times 0.6 to get a kind of a fully taxed earnings yield, and then you compare that to whatever the treasury bill is, and if it's attractive, then it's a good buy. Is that kind of?
Yeah, and that's what he's looking at. Is he's in true business fashion form. Oh, sorry, got something in my way. He is comparing it to the
risk-free rate, essentially.
The risk-free rate basically is what it is. And so he's just saying, hey, this is the risk-free rate.
Yeah.
And I'm just identifying it. So
yep.
And I just wanted to do that
okay.
because it was something that he had pointed out in that lesson.
Mm-hmm.
So.
Yep. No, that makes sense.
We spent a lot of time looking at that good business test the last time, which I think you and I both did a really good job at identifying what makes a good business test for us. I'm just curious, for you, Rich, do you have like a limit on how low or how high or how low you want the return on capital to be when you're looking at a company?
No, I don't, is I guess the short answer. I mean, I guess similar to a lot of investors that I've kind of grown to appreciate through lessons learned, that it's good to invest in good businesses. Because if you invest in a crappy business and then something goes wrong, you know, the downside, your downside really isn't protected. So it's nice to kind of have that built-in downside protection to have a really, you know, high quality business. So, you know, I don't have a hard and fast rule, but it's something that I definitely look at.
Yeah. Yeah. So an interesting thing about this is Joel Greenblatt also in that same lesson, he kind of gives the rest of the story for Duff and Phelps. Duff and Phelps had the spinoff and he went ahead and bought it for $24 a share. And the market started to realize that it was a good deal. So they started buying up shares. And then another company started to realize it, which often happens with spinoffs, and it got acquired. And it got acquired at about $100 a share. So that projected price actually was closer to that 20% growth rate at a price to earnings indicated ratio of 13% or 13 times. So it was just an interesting thing to watch with that. So
did he, and I need to review these notes, it's a good resource, but did he provide any commentary on kind of how to estimate maintenance CapEx, or was that something that maybe Duff and Phelps provided?
Oh, yeah, let's see. How did he go about that? Let me see if I can find it real quick. Can you see the lecture on this, or is it still in the Duff and Phelps?
Yes.
Okay. So let's see. I'll see if I can find it. I think he had, there we go. There was one more. Nope, you're right. I don't think he really dug into that too much. I think, so the thing that Jim pointed out when he emailed us this is he identified that the maintenance CapEx is usually a percentage of your sales. At least that's what if I remember right. That's how he approached it.
We talked to it. It's tough to you know, sometimes management lets you know what maintenance CapEx is and what growth CapEx is. Yep. Sometimes they're optimistic, right? They say, oh, we only have to spend $5 million of maintenance CapEx. You know, we spend 100 every year, but it's all growth CapEx. And, you know, sometimes that's not necessarily the case. So it's definitely an art figuring out what exactly maintenance CapEx is.
Yeah, and that is where the art is you kind of have to identify what does it cost to do that. I can't remember where I read it. I think it was another one of Joel Greenblatt's lectures, or maybe one of his books or something like that. But he talks, I seem to recall that he took some time to identify that your maintenance CapEx sometimes is associated with how much cash you have to keep on the balance sheet, because then that cash is used to buy in inventory and things like that. So anyway, awesome. Well, as we finish up, we have one final note for you. This video was made for educational purposes only. Any companies mentioned in this presentation were discussed for educational purposes only. Discussing such companies and the specifics about them is for illustrative purposes only and not a solicitation to purchase them. We recommend that you conduct your own research and identify why you might want to own the company yourself before you commit any funds. We also recommend that you seek the services of a financial advisor that has considered your situation as your fiduciary. May your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks.